Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is securitization, what to expect in 2023, and we'll be focusing on updates and trends in auto and equipment securitizations, including the SEC's recent conflict of interest proposal, RMBS, CMBS, and FinTech. My name is Miller Smith, and I'm a partner in Mayor Brown's Charlotte office and a member of our banking and finance practice. My co-presenters today are also members of our banking and finance practice, Jesse Dower, a partner in the firm's New York office, and Jenna Hartnett and Melissa Kilcoyne, who are partners in the firm's Chicago's office. And to start us off, we'll have Melissa give us an update on auto and equipment securitizations.
Thanks, Miller, and welcome everyone. I will be starting off our discussion today with an overview of auto and equipment securitization trends and updates. I'll also touch on the SEC's recent conflict of interest proposal and the UK-EU securitization regulation. Across the auto and equipment space, manufacturers have struggled with supply chain disruptions and strong vehicle demand for the past couple of years. Low inventory particularly strained floor plan master trusts and resulted in amendments to their financing facilities and a reduced issuance of securities overall. As these floor plan and other issuers look to re-enter the market in 2023, they may be facing increased losses and delinquencies as the new challenge. Auto loan issuers, particularly in the subprime space, are also facing rising delinquencies and potentially an increase of required credit enhancement, both of which present business challenges in a higher rate environment where financing itself is already more expensive. Overall, at the start of 2023, ABS demand has been strong with tighter spreads than the latter half of 2022. However, we've seen banks and mezzanine lenders appear to still be more cautious in providing warehouse lines, especially in the subprime auto space. Pricing may also continue to fluctuate based on rate increases at the Fed and new jobs reports. Auto and equipment issuers will also continue to grapple with the CFPB and state regulatory scrutiny. The main areas of focus over the last year have been around deceptive practices, consumer ability to repay, add-on products, including gap coverage, and dealer compensation. We expect those to continue at the federal level and across some states. For example, California legislation regarding gap coverage is a relatively new concern that forced auto finance companies to quickly integrate new language into their contracts and make changes to ensure compliance with the new law. The size of California makes it a key state to watch, as securitizing loans from this large state is critical to many auto finance companies. One particular securities law issue that may have far-reaching consequences to the securitization markets is the SEC's proposed Rule 192. This revises and reproposes Rule 127B from 2011 that was never implemented. As a very brief overview, Rule 192 would prohibit a securitization participant in an ABS from directly or indirectly engaging in any conflicted transaction during the applicable period. This new rule applies to Exchange Act ABS and includes unregistered ABS and synthetic ABS. Breaking the rule down a bit more, securitization participant is broadly defined to include sponsors, underwriters, initial purchasers, placement agents, and their affiliates and subsidiaries. Sponsor, as proposed in Rule 192, is broader than the definition used in Dodd-Frank, Regulation AB, and Regulation RR. It picks up all parties that, whether by contractual right or otherwise, play a non-administrative role in directing or causing the direction of ABS, or the composition of the pool assets. Affiliates also picks up foreign affiliates, which would be particularly difficult for large organizations to manage. Unlike many regulatory rules related to ABS, the proposed Rule 192 does not include any exceptions for affiliates and subsidiaries that are walled off by typical information barriers. But the SEC is also specifically requesting feedback on this, so we'll have to stay tuned and see what changes there. A conflicted transaction includes two components. Part 1, type of transaction, and Part 2, materiality. For Part 1, the type of transaction, this includes short sales of ABS, credit derivatives, and the last category, other transactions in which a securitization participant would benefit from an actual or potential adverse performance in the deal or a decline in market value. The last transaction type is very open-ended and likely to cause a lot of hand-wringing over what qualifies. Component 2 to the test, materiality, means a substantial likelihood that a reasonable investor would consider the relevant transaction important to the investor's investment decision. This includes a decision even to retain the ABS. The SEC's proposal did include some specific exceptions. For example, the release expressly excludes risk mitigating hedging, liquidity commitments, and, quote, bona fide market making activities from the rules provisions. Even though the new Rule 192 is much more detailed than the original proposal from 2011, there remain significant points of ambiguity and concern for participants in the ABS markets. One such point of ambiguity is related to a broad anti-circumvention provision that prohibits a securitization participant from engaging in other transactions that circumvent the general prohibition and create a material conflict of interest. As drafted, this could pick up additional activities that would otherwise not be triggered by the above tests. The applicable period for the rule begins when the securitization participant has taken substantial steps to reach an agreement that they will become a securitization participant, and ends 1 year after the final sale. The rule does not require any intention or knowledge to trigger a violation. In the release, the SEC asked participants to give feedback on many specific questions, but there is a very short comment period that's still a focus of a lot of concern in the industry. It's asking for comments by March 27th or 30 days after publication in the Federal Register, along with preparing responses to specific SEC comments and raising various concerns. Market participants and groups are expected to ask for an extension. Moving on to a brief overview of the EU-UK securitization regulation and related developments. In October 2022, the European Commission published a report that made clear EU regulated institutions would need to comply with the due diligence requirements under the EU securitization regulation, including asset level data on specific templates. This includes transactions where EU institutions are investing in US-sponsored ABS transactions. In general, US issuers have been hesitant to incur the time and extra expense to strictly comply with the existing templates on asset level data. Instead, many US term issuers of ABS pivoted to disclose that their deals are not compliant with the EU securitization regulation. In private lending facilities, we've seen a bit of a divergence. Borrowers in EU banks have had to figure out middle ground positions so that the EU banks have some form of contractual comfort on compliance that they can point to in the agreement and show regulators that they're trying, but they have the borrowers on the other side not wanting to, undertake the expense and everything else with strict compliance and providing that asset level data. In the 2022 release, the European Commission invited the European Securities and Market Authority, known as ESMA, to prepare a simplified template for private securitizations and to review all templates to remove unnecessary fields and align with investor needs. ESMA asked for industry feedback by February 10th. Note that the UK rules now diverge from the EU rules, and that is expected to continue into 2023. I'll now turn it over to my colleague, Jenna Hartnett, to discuss developments in the RMBS space.
Thank you, Melissa. Given the volatile interest rate environment, origination of mortgage loans and in turn issuance of the residential mortgage-backed security volumes decreased year over year in 2022. We saw a 43% decline in private RMBS in 2022, as noted in the SFA market snapshot, a 61.5% decline in QM private ABS as noted in the asset back alert, and a 54% decline in agency RMBS as noted in the SFA market snapshot. However, home equity lines of credit, or HELOCs, and closed-end second lien mortgage loans are gaining in popularity. Originations grew 210% over 2021. Today, we want to highlight some trends that we find particularly interesting in what we broadly refer to as the residential mortgage loan space. We will discuss HELOCs, other home equity products, SFR and iBuyers, and the outlook for MSRs in 2023. Mortgage lenders are adding loan products such as home equity lines of credit, second lien loans, and other alternative forms of credit to tap into existing home equity and bolster loan origination volumes given the lower originations of traditional mortgage loans and growth in home equity over the past few years. Given the increase in origination of HELOCs, we expect to see increased HELOC securitization activity in 2023. HELOC securitizations are similar to other private RMBS securitizations. They have a more simple bond structure than other RMBS securitizations, and a unique feature is that they need to have mechanics for funding additional draws on the HELOCs. We also anticipate continued interest in specialty finance products, including home secured credit cards, mortgage consumer hybrids, home improvement financings, and solar financings. Given the unique features of these loans products, they require additional analysis regarding state licensing, usury, and regulatory compliance considerations. For example, some jurisdictions have separate licensing laws for the origination of second lien loans. Small Loan Act and Uniform Consumer Credit Code provisions may apply depending on loan balance and or interest rate and available exceptions. In addition, we continue to see activity related to single-family renter, or SFR, iBuying, rent-to-own, and home equity option contracts. In 2023, S&P forecasts that SFR issuance alone will be around $10 billion, which is slightly below 2022 levels. In addition, the Wall Street Journal reports that interest rates and historically high home pricing continue to pressure prospective home buyers, many of whom will choose to rent an SFR property over home buying. Others may seek affordability support with rent-to-own or similar products. In 2023, we anticipate that non-securitization financing of these assets will continue to be in high demand. Warehouse volumes remain high, even as pricing continues to constrain borrowers with tighter advance rates and wider spreads. In addition, some in this space are looking towards using titling trusts to finance these properties. Titling trusts are particularly well suited for iBuyers. While titling trusts are complex to set up initially, they can facilitate financing of SUBI interest rather than requiring an SFR-style accommodation loan. In addition, it provides an ability to easily finance the real property assets across different facility types. For example, assets that are ready for sale, assets that are under renovation, or aged assets, with appropriate advance rate and conditions. Titling trusts could also be used for SFR operators, especially as they acquire assets and seek warehouse financing. The rising interest rate environment has made investing in MSRs attractive to investors. Given the higher interest rates, there is a less risk of refinancing the asset. We have also seen and expect to see further transactions involving the sale and financing of mortgage servicing rights. In addition, there will be a need for increased servicing advances and financing for those servicing advances. I now turn it over to Miller Smith, who will discuss commercial mortgage-backed securities topics.
Thanks, Jenna. I'm going to speak today about what to expect in CMBS in 2023. So everyone knows that issuance is down, and the Commercial Mortgage Alert noted that the annual volume of commercial mortgage securitizations was at a 4-year low in 2022, with only $187.4 billion of deals in the U.S., which is down 34.4% from the record set in 2021. And there were major declines across the board, including in agency, conduit CMBS, single asset, single borrower deals, and CRE CLOs. With rising interest rates and other market conditions making securitization execution so costly, issuers and loan originators are looking for other ways to get matched term financing for their loans. We've started seeing a few different alternatives crop up, and we expect we'll continue to see these types of alternative structures until the markets settle back down. One example is the Freddie Q deal structure, which was first introduced in 2014, and it offers an alternative takeout strategy for multifamily bridge loan originators that have sufficient affordable housing units in their portfolio. So the Q shelf is designed for loan packages that are originated by a single third-party lender that meet the underwriting standards and include affordable housing properties. Freddie re-underwrites the loans, and then the top tranches of the deal are ultimately backed by Freddie's guarantee. There's a guarantee fee that's associated with these deals that the issuer has to pay, and it's reported that fee can vary depending on the composition of the portfolio. But for comparison's sake, and to show you why this could be an attractive alternative for issuers, it was reported that the guaranteed tranche of a deal that closed late last year sold at 87 basis points over 1 month SOFR, and the top tranche of a CRE CLO that priced around that same time was 270 basis points over SOFR. We're also seeing loan originators seeking matched term warehouse financing, and we've even seen commercial mortgage loans financed via a total return swap. As far as the underlying loans themselves, 2022 saw steady improvement in credit fundamentals, but that was eventually undermined by rising interest rates and the hesitance and/or inability of borrowers to refinance at maturity. This is evidenced by the percentage of loans in special servicing, which is reportedly at only 5%, which down from the pandemic era high of 10.5%. And the CMBS 60-day delinquency rate is currently around 3%, which is lower than the 5% we saw at the peak of the pandemic. It's predicted that the delinquency rate will increase to about somewhere between 4.5% by year end. However, it is worth noting that 90% of the delinquencies in December were maturity defaults. As far as regulatory updates affecting CMBS in 2023, the market will definitely be focused on the new conflicts of interest rule that Melissa spoke about. There's also a focus on the Home Mortgage Disclosure Act. This has been around since 1975 and was designed to end discriminatory lending practices by requiring reporting of loan level information. Previously, only originators of more than 100 loans for a 2-year period needed to report, which was around 2,500 lenders. But there was a recent ruling that vacated the prior rule as to that loan volume threshold, and the level is now at 25 loans for the 2021-2022 2-year period, with a requirement to start reporting at the end of 2023. That obviously increases the number of originators that would be subject to that requirement. However, the industry is pushing to exempt multifamily lending from this HMDA rule, and so we'll have to see whether or not that effort is successful. In addition, the National Flood Insurance Program was reauthorized at the end of 2022, but that was only until September 30th of 2023, which means that we'll be looking to Congress to reauthorize that again at that time. As far as what to expect in the CMBS market generally in 2023, the Fed's rate hikes have really depressed demand for fresh debt, and discretionary refinancing has virtually disappeared such that everything is maturity based. The biggest issues are inflation and the related rate hikes, which some optimists see leveling off by mid-year, but that obviously remains to be seen. For new originations, a mortgage obtained at 3.5% a couple years ago might now attract an all-in interest rate of 6.5%. So when you capitalize a given income stream at this new rate, you come up with a smaller target loan amount. Plus, net income is lower because the borrowing costs are higher. So many owners are unwilling or unable to inject more money into a property that wouldn't qualify for a loan of the same size. And we expect, because of this, we will see a lot of loans that are going to require some level of resizing. We do expect acquisition financing may pick up as some owners choose to sell properties because of refinancing challenges or because they just need liquidity. And there's approximately $162 billion in commercial mortgages that are reportedly scheduled to mature in 2023. A majority of those are in single asset, single borrower deals, and most of those loans have embedded extension options, but the expectation is that they will mature. So while there is some concern around refinancing CRE loans in general in 2023, in particular with respect to office properties in light of, among other things, evolving workplace dynamics, recessionary pressures, and other downsizing, market participants do expect that there is liquidity available, if not with big banks or GSEs, then with debt funds or other private lenders. But it just might not be on the terms the borrower wants with respect to pricing or otherwise. But with some optimism that we'll see rate increases slow or begin to reverse in the second half of the year, there is still hope for CRE issuance in 2023. It's expected that issuance may still decline year over year, but it's not expected to plunge like it did in 2022. In the agency world, we expect that congressional housing goals will impact GSE behavior, but as a general matter, multifamily remains strong, and Fannie and Freddie are expected to do at least as well as last year in that sector. For conduit CMBS, tightening spreads are making some people cautiously optimistic, even over just a few weeks ago. And there seems to be a lot of focus on 5-year conduit deals, which market participants expect will do well. These 5-year deals are primarily driven by borrower demand for shorter-term loans, but there's investor appetite as well in light of the shortage of the 10-year conduit paper. But as a general matter, market uncertainty will likely slow the deal flow in 2023. Market analysts predict it could take up to a year before CMBS markets really rally. And in particular, it's expected that the first half of this year will be pretty volatile. And a market survey done by the Commercial Mortgage Alert indicated non-agency CMBS is expected to dip another 7.8% for this year. In the CRE CLO market, the first CRE CLO of 2023 priced a few weeks ago, and the senior notes were oversubscribed. Spreads widened down the stack, but some market participants believe that the execution was strong enough to encourage other issuers, and the second deal of the year priced recently at similar spreads. The first single asset, single borrower deal of the year also priced at slightly tighter spreads than anticipated initially. These deals are attractive to investors because the credit is easy to understand, and it's anticipated that many of these deals this year will be executed as 5-year fixed rate loans as well. So we expect to see continued volatility in this space, but there is definitely some momentum in recent weeks as far as new issuance, and we hope to see that trajectory continue. And now I'll turn it over to Jesse for the FinTech update.
Thanks, Miller. I'm going to be speaking to a few recent trends we've been seeing in the fintech space and expect to continue to encounter this year. The recent change in the macroeconomic climate has generally had an impact on the fintech industry. One consequence is that we are seeing a transaction parties move to a flight to quality. Certain lenders and funds are trending towards more established companies. And strong fintech companies with market leverage are starting to narrow the parties with whom they transact. For example, if a company has been doing business with 20 funds, they are starting to take a look at which funds were the best partners to them and upping commitments with those partners while letting some other deals run off. High-level economic changes have also had an impact on the deal-level documents. With respect to transaction documentation, we are seeing more of a focus on negotiating indemnities, default provisions, and rep and warranty packages, all with a general trend towards being more lender-investor friendly. With respect to indemnities, investors and purchasers in fintech companies and assets are pushing for stronger indemnities to cover litigation risk and licensing and regulatory concerns. With respect to default provisions, we are seeing a tightening of grace periods and an expansion on regulatory events leading to a default. In line with this, we are seeing an expansion of rep and warranty packages from fintech companies to be more lender-investor friendly, particularly with respect to eligibility criteria on the assets. In structuring a transaction, one of the elements we expect to see parties focus more on in the upcoming year is the backup servicing arrangement. As compared to more established companies and asset classes, young fintech companies are more likely to have financial difficulties, and as the sponsor borrower of the transaction is most often the servicer, an investor will want to be sure to focus on a strong backup servicer. It's important to select a backup servicer who can truly take over should the need occur. Investors should plan to do some level of diligence on the proposed backup and make sure that they have the ability to actually take over the servicing and do a reasonable job. The correlation risk that the backup servicer may also be taking over servicing for others simultaneously in a down economy in the future should also be considered. Over the past year and going into 2023, we have seen many investors focusing on having the form of successor servicing agreement in place at the time of closing by negotiating the substantive terms of the arrangement during the deal negotiation rather than relying on a transition plan, which used to be quite common. It's recommended to negotiate the terms of which servicing rights and obligations the backup servicer will have in the event they need to take over for the existing servicer. Waiting to negotiate the terms of the successor servicing agreement until the existing servicer is in distress can lead to a lapse in adequate servicing. It can also lead to the lender investor having to agree to increase servicing fees, decrease servicer responsibilities, and even investor indemnities or advances in replacing the existing servicer. Although a backup servicer has become more common, especially in the fintech space as compared to some assets, we may also expect to see an increase in including a backup administrator in some transactions. If the fintech company is in distress, lenders will want to be sure that there is an entity in place to manage the day-to-day operations of the SPV, such as completing annual good standing filings, paying associated fees, and directing the trustee to take actions. By negotiating the substantive terms of the backup servicing and administrator roles at the time of the original transaction closing, parties should be able to avoid many of the pitfalls of not being adequately prepared. As just discussed, the transition plan may not work, the successor servicer may not be prepared to service in the same manner, and given the limited roles of trustees generally, investors likely can't rely on the trustee to fill any gaps in servicing if the company is in distress. In sum, we do expect to continue to see a lot of securitization in the fintech space, but with the aforementioned changes to the deal terms. In addition to impacts on the fintech industry from the economic environment, we also expect to see impacts due to the changing regulatory environment in which fintech companies operate. Many fintech companies partner with a state-chartered bank in connection with the origination of their consumer assets. As certain fintech assets attract increased attention from regulators at both the national and state level, we have generally seen bank partners shying away from certain jurisdictions. A recent example is from the state of Iowa in December of last year. In that case, Transportation Alliance Bank entered into an assurance of discontinuance with the state of Iowa to settle claims against the bank that it charged interest rates exceeding Iowa's allowed maximum rate for supervised financial organizations. The state of Iowa interprets the state's election to opt out of the Federal Depository Institutions Deregulatory and Monetary Control Act to mean that an out-of-state, state-chartered bank cannot export its home state interest rates in loans made to Iowa residents and therefore must comply with Iowa's maximum allowed interest rate. The AOD is likely to result in out-of-state, state-chartered banks excluding Iowa residents from their loan programs or limiting the rate of interest on these loans to 21%, which is the allowed maximum interest rate in Iowa. It should also be noted that this recent action is different than many other recent regulatory actions in that it was taken against the bank as opposed to the fintech company, so there was no need to consider true lender issues. Two final items to discuss is that at the end of last year and beginning of this, the Federal Trade Commission announced two proposed rulemakings that could be of significance to the fintech industry looking forward. In October 2022, the FTC announced a proposed rulemaking to address junk fees, which are extra charges associated with products or services that companies fail to disclose upfront or that provide no added value to the purchaser as an unfair and deceptive act. There is no proposed rule yet, and the rulemaking is expected to take time. Fintech companies may currently charge fees that could be subject to scrutiny in the future, and lenders in such companies may choose to perform additional diligence on the nature of the fees being charged by fintech companies. In addition, in early January, the FTC announced a proposed rulemaking that would prohibit nearly all non-compete clauses between employers and workers, including with respect to existing clauses, as it is, quote, an unfair method of competition, which stifles both the ability of workers to change jobs for higher wages and the ability of competitors to obtain qualified workers. The comment period is currently ongoing. In addition, there are many potential legal challenges, including statutory authority, that could delay any final rule. The potential rule would not apply to regulated banks, savings and loan institutions, federal credit unions, and nonprofits, among others. Outside of California, many fintech companies currently utilize non-compete agreements. Although there is a carve-out from the proposed rule allowing non-compete clauses in connection with the sale of business where the selling worker owns 25% or more of the sold business, the ownership percentage is quite high, meaning a non-compete against a selling worker owning less than 25% of a sold business would not be enforceable. I now turn it back over to Melissa for closing remarks.
Thank you, Jesse, and thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.